All right, welcome back to another edition of Advanced Accounting. We are going to try something different this time. We're going to deviate away from the modified PowerPoint slides. I want to jump into Chapter 5 lecture notes by looking at examples. As you know, with Chapter 5, we are looking at investments in a subsidiary where we do not own 100% of the subsidiary. So without further ado, let me jump into some examples. Generally speaking, when we look at the different types of investments, we're given information about the subsidiary's net assets, which the net assets we know is essentially the summation of all the common stock, the APIC net of any retained earnings, AOCI, and treasury stock. So let's just assume we have the information about the subsidiary. And what I want you to get used to doing is drawing out or sketching out the sort of the ownership spread. So at 100%, the book value of a subsidiary is, let's just say it's $10 million. And if I were to look at just my investment, what I record, let's say I own 80%. I didn't buy the full 100. That being the case, I would allocate of the book value. That means I'm going to invest in and have interest in $8 million worth of the subsidiary. Now, that being the case, where's the other 20%? The other 20% is NCI, the non-controlling interest. These are the people I couldn't convince to sell me their 20% interest. So if they're still around, they're still hanging around, I would say that they have a claim to $2 million worth of the book value of the subsidiary. Now, that being said, let's just assume for a second that when we have consultants go in and determine some fair value adjustments, they find that the land needs to be reduced down by $100,000. That means that I have a stake in that as well. That I'm going to use that information to determine what my purchase price is of the 80%. So that would mean 80 goes to me, and I would allocate the other 20 to NCI. Now, mind you, the non-controlling interest people, they're not interested in this. They don't account for any of this stuff. But to be fair, if I'm trying to allocate across in my calculations, NCI is allocated their fair share of any fair value adjustments. Now, let's assume that there is unreported intangible assets that we need to account for. And let's go ahead and assume that those amount to $1 million. I have a stake in that, 800. That seems reasonable for me to pay for that. And NCI is allocated the other 200. Now, if I just look at that information, if that's all I really know, then what I can determine is the fair value of the net assets of the subsidiary amounts to $10,900,000. Or for me, that means that I have an 80% stake in that, which is 8720, and the NCI has a claim of 2180. Now, the question comes down to this. If I'm acquiring 80%, how much am I really paying for this? Am I going to pay the 8720, or am I going to pay some amount much higher? In this case, let's assume that I'm paying $16,720,000. That would imply there is some amount of goodwill associated with my purchase. In this case, it would be $8 million. Now, do I follow the same suit and just sort of say, well, 8 million represents 80% of what goodwill must be? No, I have to stop and say, how does the non-controlling interest investors, how do they measure their fair value? Generally speaking, the NCI folks, they measure their own fair value of their investment. And let's just assume in this case, based on market rates, their stock, their 20% interest, is currently at 3180. So you can sort of see that they have this $1,180 gain in their investment. That's all they're really concerned about. They know that they buy low, sell high. They're not really worried about how, some of this has to do with a reduction of 20, and by the way, there's a 200 in unreported intangibles. They're not really concerned about that. All they really see is, this is my cost, and this is what the current stock price is. And the stock price is the most most objective way of measuring their value. It's not going to be based on what we pay. This is usually going to be done in a private sort of setting. This is sort of like a private PVT, not put, PVT, private arrangement with the board of directors of the subsidiary. So NCI, their 3180, this is something separate from how we're valuing our investment in the subsidiary. Meanwhile, we're still saying that, oh, by the way, as we're going through, we don't get 100% of the valuations or the book value. We're leaving some of that to the NCI folks. Now, that being the case, what is the goodwill that's built in or implied if I do this calculation? Well, that would be 1,000. Now, again, the NCI folks, they don't give a damn about how that 1180 is broken out. This is just for our calculation purposes. So we're not really consulting the NCI folks about what's going on in the blue column. But if we determine those are the goodwill portions, we figured out that, hey, the overall goodwill in this case must be $9 million. So the overall fair value of the company, I would say, the fair value of the subsidiary is $19,900. This is how you typically break out a partial ownership, not full 100%, but a majority ownership in a subsidiary. I would also add that we want to be very careful about how the goodwill that we determine that our portion of goodwill is relative to the overall total goodwill. In this case, notice that 8 divided by 9 is not 80%. It's something more like 89%. Okay, which means that the goodwill that we're sort of allocating over to NCI is what? That's like the 11% in that case. So we're saying that's 11%. It's just something to be aware of as we go forward, that goodwill is not necessarily an objective 80-20 split. It's based off of what we pay for ours and what they value as theirs. Going down from here, let's take a look and see what our general ledger would look like. In our general ledger, we would have an investment in, say, DMI. Let's say DMI is the subsidiary as per usual. Now, we own an 80% stake. The other amount we'll just say is the NCI investment. NCI investment in DMI. Okay. Now, what I'm going to do is essentially just take the numbers from up above and just sort of plug them into my general ledger down below. Okay, so the initial amount I'm paying, mind you, bear this in mind that I'm paying 16,720, but I like to keep track in my general ledger what that amount is really broken out into. So I have a book value portion. So let's say book value over here. Book value portion, we have the 8 million and the NCI has 2 million. So I'll put that in there. 8 million. DMI, you get the 2 million. And then there's the adjustment for land. Reduce that by 80. NCI gets their 20. And then we have the unreported intangibles. UI, not urinary infection. UI, unreported intangibles. In that case, we have 800 here. 200 over here. And then finally, we have goodwill, which is based on what we paid, 8 million, and for NCI, based on what they value their investment, it's got to be $1 million. And so you can just sort of double check those numbers and make sure 16,720 is what I have for the balance here, and I have 3180 right there. Cool. Now, once I've sort of determined, keep in mind, I'm not doing anything I'm not recording any of the NCI stuff. I'm crediting cash and I'm debiting my investment account for 16,720. That's it. I'm just making a side note for NCI's portion of all this stuff. When I go about, if I were to, at this point in time, consolidate my investment in the DMI, I would start off by saying, hey, let me start with my E journal entry first. And my e-journal entry gets rid of all the common stock accounts that make up this book value up above. So I would go ahead in my E account, I would debit any capital stock, I would debit any type of retained earnings. Hopefully I have retained earnings. I would credit treasury stock, etc., etc. But here's the thing, though. When I credit, I'm not just going to credit my investment in DMI. I'm also going to credit non-controlling interest. I'm going to create this account when I do my journal. I'm going to do my elimination journal entry E in this case. So overall, what is my amount that I'm going to credit away for DMI? Well, it's the book value. This is like the book value, the net book value of the company. So mine is 80%, DMI's is 20%. Where is that in my GL? Oh, it's up above. Here it is. Boom. I'll just go ahead and, as my e-journal entry would show, do a credit for 8 million. I'm not directly doing this in my general ledger. I'm just doing an on-top journal entry. My elimination journals are on-top journal entries. But I'm using my account, my GL account, as sort of a checklist of what I need to do. For the NCI portion down below, they're 20%. I'm going to go up above and say, oh, there's the 2 million right there. I would go ahead and credit 2 million as an on-top journal entry. Oh, no, not blue in this case. Let's go ahead and keep it purple. 2, 1, 2, 3. That's my credit. That's the NCI portion down below. So these guys, what we saw down below here in my journal entry E, that's what's going on right there. From that point, now I do my R journal entry. I say, okay, what about my revaluations? Well, in this case, I've got a bunch of line items. I've got to reduce land, I've got to recognize unreported intangibles, and I got to record goodwill. And what that looks like is essentially my R journal entry would be debit to the intangible asset for whatever it is, debit the amount, let's see here, the goodwill, and then I would have to credit the land. Now, the amounts that I'm crediting here are for the full amount, not the partial amount, okay? So the full amount of the UI in this case is 1 million. I need to show in the consolidated balance sheet $1 million worth of urinary infection. No, unreported intangibles. I need to show goodwill of how much? 9 million. Remember, we got that from up above. The 9 million is right there. Okay, so that's what I want to show, the total amount, not just the breakout portion. So I want to show 9 million. And with land, I want to show not the breakout portion, but a credit to 100,000. I want to I want to credit my investment account for whatever portion, the 80% I'm responsible for. And I want to credit the non-controlling interest for their 20%. And I could go about and do the math in this journal entry if I want. That's fine. Or I could just kind of go back to my general ledger and do the checklist. If I net all these guys together, what do I get? Well, let me look at my information. I net the 80 reduction, the 800 increase, and the 8,000 increase. In this case, it's 8720. So I would do a credit 8720. And when I look at these guys, when I net those guys together for the NCI, it amounts to 1180. 1180. These are just on top journal entries. I'm not really recording these in the ledger. These are what we see right here over in our journal entry R. And that's how we go about dealing with, at a basic level, as a starting point, how we deal with our investment in a subsidiary where we don't own 100%. That's the breakout. Next thing we're going to look at is take a look at a situation where we have other types of things to incorporate in our overall elimination accounts. So now in this situation, I want to take it out 1 year after ownership. So again, let me start off with some basic facts. The book value of DMI's book value of DMI's net assets overall at 100%, if I'm looking at 100% of the company, let's assume it's $50 million. And now in this case, let's assume I have 75% ownership. Well, how much does that mean I have a claim to in terms of book value? 37,500. What about the other 25%? It's NCI. That's their portion. Essentially, they have a claim to the other portion of the 50 million, or 12,500. Now let's further assume that all we really have is an unreported intangible asset worth, say, 100 million. My claim to that fair value adjustment would be 75, and NCI's claim would be 25. Okay. Now, when we sum those up, we see that the fair value of the net assets in this case is 150, where I have a claim of 112,500, and the other claim goes to NCI of 37,500. Question comes down to this. When I paid for the 75%, did I pay up 112, or did I pay some amount higher? Well, in the facts, let's assume that I paid 212,500, which means that my goodwill, I must have goodwill in this case, my goodwill would be $100,000. Do I allocate that over to NCI? Absolutely not. I'm not concerned about necessarily how NCI determines its goodwill. However, what I will say is, based on the stock price, if I were looking at 25% of the outstanding stock, the stock price being traded at what it is, I can determine objectively that, hey, the stock market values the stock price at a certain amount that totals up to 57,500,000, which means that if I were the 25% non-controlling interest owner, that means there is some sort of implied goodwill of 20 million in this case. Again, do I really care? No. All I really know is I've got a major gain here. Okay. Essentially, I have a basic claim of 12,500 for my 25% interest in the net book value of the company, but currently the stock price is trading at 57,500. I'm looking pretty good. Let's ignore what the NCI folks actually paid for the stock for the time being. But given this, what I can say is, if I add those suckers across, I get goodwill, total implied goodwill of 120,000. So the overall fair value of the company, of DMI itself, is the 27,000. Just good information to know. But again, what is mine? What is the 100 as a percentage of 120? Is it really 75%? Actually, it's not. It's more like 83%, interestingly enough. And that means that the overall $20 million implied goodwill for the NCI folks, that makes up the other 17%. So it doesn't necessarily, the goodwill allocation doesn't necessarily have to equal the percentage ownership relative to me. It's just good to know going forward, hey, what is the goodwill allocation between us? After I figure this out, next step I usually do is I go through and I start building out my investment account. So the investment in DMI, that's my general ledger account. And then I'll just, as an aside, I'll keep track of NCI's portion, their investment, their 25% investment on the side. In this case, I'll start off with the book value. What's the book value portion that I paid for? 37,500. What's the urinary infection? 75,000. And then there's goodwill of $100,000. That's all these items from up above. I'm just bringing down into my ledger. Total amount that I paid was $212,000. So if I just sum those guys up, I can see 212,500. Yep, that's the cash. I credit cash and I debit the investment account. That's what I paid. But here's the breakout of what that's comprised of. It's good to know. 12,500 is NCI's portion of the book value. They get 25,000 worth of UI, and the 20 million other portion there. We sum those up, gets us to 57,500. That's how they value, that's how they determine their fair value of the 25%. Our fair value, the 212,000, that's based on what we paid for our 75%. The 57,500 is based on whatever the stock price is. So these are kind of independent valuations. I want to make sure that's clear as we go forward here. Okay. Now, during the year, let's assume that there was net income of, say, $5 million. And we found out that the goodwill, when we did an impairment testing, the goodwill was impaired to the amount of $1 million. Okay. So how do I use this information when I go about doing my journal entries? Well, the net income I'm entitled to is 75% worth. So in this case, I will 3750. That's my debit. The credit would go to the equity in the subsidiaries' earnings. So down below, I would have a credit 3750, and that would increase my overall net income on my consolidated balance sheet. Or excuse me, that would increase my overall net income on my individual Beerbow income statement. So that's a good thing. I get to show that as income. It's my investment. There's my income from my investment. When I consolidate, however, with DMI, I have to realize that that 3750, that's got to go away. I'm going to consolidate 100% of the net income, not just the 80%. What about NCI? Well, they get their 25% share in this sucker. So 1250, that would increase their 25% ownership. And they would have, guess what, NCI's equity in DMI earnings. Yep, they get their share of it too. Now, mind you, they're not doing these blue journal entries. This is just us kind of keeping notes off to the side, like, where's the whole 100% going? We get 75, NCI gets 25. Same process is what we use when we allocate across the impairment of $1 million. So in this case, is it goodwill that's impaired, or is it, excuse me, I think it's not goodwill. I believe it's the UI that's impaired. We'll take a look at impairment of goodwill later. That has its own sort of implications, right? But we're basically saying there's an impairment of the intangible asset in this example. So if we look at that, we say, okay, 1 million, you got 750 over here. That's unfortunate. We would have a 750 debit on that side. And if I were NCI, I would show my portion of that, just like that. And when I go through and sum up those things, I see that my overall balance is 215,500. For my equity in DMI's earnings, I have 3 million. Not too bad. NCI's investment is 58,500. And they would show essentially their claim overall to the earnings of DMI is $1 million. Again, now we come to the end of the period. These are our balances. How do we eliminate those 1 year later when we want to consolidate? First thing I would look at is journal entry E. So I'm going to go across here. Journal entry E, purple. If I need to get rid of the book value, essentially I'm getting rid of, in the e-journal entry, all the equity balances as of the beginning of the year. Not the equity balances at the end of the first year, but equity balances as of the beginning of the year. The net sum of the equity balances is 3750. It's allocated between common stock, APEC, retained earnings, etc. And we would go ahead and debit common stock, retained earnings, based on what DMI is showing. In this case, I'm just going to summarize this by saying, hey, look, that 3750, I'm going to show a 37,500 credit when I do my journal entry E. These are just on top journal entries. That's why I'm highlighting. In the case, if I'm DMI, I want to get rid of my stake in the book value, 12,500. And that's how I deal with journal entry E. Oh, pretty little, happy little tree. Okay, So that's journal entry E. What about the next one, journal entry R? Journal entry R, when we go through, we want to deal with all the fair value adjustments as of the beginning of the period. So the fair value adjustments we see up above for our side was the UI and the goodwill, totaling 175. So I need to remove 175, and NCI would remove 55. Oh, excuse me, 45. I can add 10,000 here, 10,000 there. Yeah, it's peanuts. Okay, that would be how I would show journal entry R. Okay. This is also the thing I like to do. I like to cross these things out in my notes just so that I keep track of what I've gotten rid of, how I've emptied out my investment account. But let's move on now. We're going to take a look at now the current year activity. And current year activity is pretty much just net income and dividends. So do we have any of those? Well, yeah, we do. We've got net income, we don't have dividends, but we also have this fair value this impairment, if you will, right here. This is also current year activity that we had to deal with. So our portion that we need to empty out, if we net those together, is 3 million net. And if I am NCI, I net those together. I need to get rid of their portion, but I'm going to do it in a separate way. This is usually where I kind of disagree with how the authors deal with the NCI portion. Usually I like to do that in one fell swoop, one line item. But let's just focus on us for right now, the C journal entry. Getting rid of that 3 enables us to eliminate whatever we have in the equity and DMI's earnings. So that's what journal entry C does for us. The authors say, after you've done that, then do the NCI's portion. So NCI would come through and say, oh, we have this we have this 1 million that we need to get rid of net right here. And so that would be offset by a debit, a 1 million debit to their equity. And so that would get rid of theirs. We've gotten rid of ours. So we're cleaning house as we go through and do these different eliminating journal entries. So I'm happy so far with that. What is the final step? This is the one that people tend to forget. We have emptied out effectively everything up above. We've gotten rid of all the book values, the fair value adjustments, the net income items, the adjustments to the fair value the amortization, the fair value adjustments. We've gotten rid of all the NCI's portion of these things too. Now, essentially what this has done is it's wiped out all the investment in equity, investment balance, and the equity in DMI. That's gone. But people tend to forget that some of these things that we recorded before, in particular, any type of amortization or impairment, this actually needs to show up in our consolidated financial statements. So people tend to forget, oh, were there any write-offs in this case? And we say, yep, there was. And assuming that I have a little account over here called impairment losses, that's going to show up on my income statement, ouch, as a debit for the full 1 million. So even though I got rid of, where is that sucker? I got rid of there's the 750 portion, there's the 250. I reversed those things out down below when I did my eliminating journal entries. But just because I got rid of them doesn't mean they didn't happen. Those things did happen. I'm just sort of reallocating them to a different part of the income statement. I'm actually going to show it as its own impairment loss. So that's the whole idea about the O. It's saying, wait a minute, did we eliminate something that really we should recognize on the income statement? So that's how I would go about doing keeping track of all the individual elimination journal entries. Let's talk for a second about each one of these, just to be clear. When we're looking at journal entry E, remember that we're going to be debiting common stock or capital stock, APIC, retained earnings. We're going to do it for the full amount that we see on the subsidiary's balance sheet. We're just simply, in our case up above for journal entry E, we're breaking this out between our investment I can write investment in DMI to the extent of 3750 500 and crediting the NCI. We need to do this credit to NCI for 12,500. So we're not doing a debit to common stock 75.25. We're just going to do it for the full amount, which is the 50. If you recall from up above, the full beginning balance of the net book value is the full balance of the equity accounts. So that total amount from up above was $50 million. We're breaking it out there. For journal entry R, again, we're going to be recording the full goodwill, the full amount of goodwill, the full amount of the unreported intangibles. So in that journal entry, when we're doing R, we're going to be debiting the intangible, which was previously unreported. We're going to be debiting that for the full amount, not just our portion or NCI's portion, but the full 100%. We're also going to be debiting goodwill for the full 100%. And how much was that? Let's take a look back up above here. Goodwill, we saw, there it is, 120. Yes, we did our portion and we kept track of NCI's portion, but hey, goodwill in total was $120,000. So 120, or is this million? I forget. We're doing millions, I guess. So that's 100%. But when we break it out between the different investment accounts, we have to be mindful that, hey, we only did for the investment in the subsidiary 80% of those guys. And the rest was handled by the non-controlling interest. They're 20%. So this is the same kind of journal entries we've seen before, but we're just kind of breaking it out between us and NCI. And how much was us and NCI? 175 and 45. 175 and 45. Boom. Okay. So again, keep in mind that these guys have to be for the full 100%. Same thing with the equity. It has to be for the 100%. Now, if I go back above, what are the other journal entries? C. Journal entry C. I had to debit the equity in DMI's earnings. This is what I show in my GL, which was net. The net balance was 3, right? It was the net income, which was like 3,750, but then we had to reduce it by the impairment, 750. We're just going to get rid of the full balance. And then by doing that, let's see here, we're debiting that, and we're going to be crediting the investment in DMI 3. And we follow that up right away with what the NCI folks would be doing. On their side, they would be debiting equity in DMI. And we'd be crediting the non-controlling interest. So we go about doing this. And this seems kind of silly because, hey, they're not really recording this stuff on their end, right? True, but you'll see how it all plays out in the end. It works, ultimately. It works for us. So equity in DMI was the 1 million. And then we finally follow that up with O. Oh my God, we forgot something. We had to deal with the impairment. The impairment loss. Yikes, for the full 1 million. That actually happened. Credit the intangible for the full 1 million. Yeah, so I just want to break those out. Just make sure that we're clear about when we're doing these journal entries. Yes, and some of these we're dealing, what a portion is 80, what portion is 100, right? In this case, it was 80%. Or not 80%, this is 75%. Is that right? Shoot. Up above, this was a 75-25 breakout. That's my fault, folks. What would sloppy here? This sucker should be 75-25%. You probably already caught that because I make these little mistakes. 75%, 25%, right? And this is the full 100%. And that's how we do those for that particular problem. Now I'm going to look at a weird situation. I'm going to give you the spoiler alert here. It's one that tends to cause people a lot of frustration. It's a situation where we have a gain on bargain purchase. Now, a gain on bargain purchase is a situation where the fair value of the net assets I buy, I'm paying less than that. So I'm getting a hell of a bargain. So let's look at that. If I have NCI, I look 100%. Let's assume that I own, or I'm buying 80%, and NCI is the other 20%. If the book value in this case is 50 million, my portion of that is 40, and NCI would get the other 10. Now let me go down the list and just focus on the 100% column. Land has an adjustment downwards of 1 million. There's plant asset adjustment downward of 4 million. Okay. And there is urinary infection, unreported intangibles of 6 million. So the total fair value of the company in this case is 51. Okay. Not a whole lot above their book value. All right. Now, in this case, what is my portion of the allocation? Well, before we get carried away, here's what I want you to do, right? I want you to put down your pen and just watch, okay? There's going to be some weird things that happen here. Okay, we're going to discover as we go through this process that there's a gain on bargain purchase, and we do not want to allocate any of it to the NCI. But let's just assume we went about this kind of blindly, mechanically. How would we go about allocating this? 800, 3,200, 4,800. Now, when I sum up those, what I get is 40,800. Now, I can compare that to what ultimately will be the amount I pay is 40 million. But before I get to that, let me sort of skip over to NCI. Again, don't be writing this down yet. You'll sort of see how we have to sort of relook at this stuff. 200, let's see here, 800, and 1,200. Okay? If I sum those up, I get 10,200. If I compare this 10,200, the fair value of the net assets, to the actual fair value per the market, and I find the market is valuing 20%, the NCI 20% at 8,000, this would suggest that there's a gain on bargain purchase here of what? 2,200. Okay? That's not a real phenomenon that's existing with these NCI folks. These NCI people, they're just passively holding on to their investment. Maybe they're not really in a loss position. Maybe they bought it below 10,000. Maybe they bought it well below 10,000. Maybe they're not really in a loss position. Maybe they're in a huge gain position. That's none of our business. But in this situation, it doesn't seem reasonable to say, hey, look, you, the NCI folks, have a baseline of $10 million, and therefore you have this weird gain on bargain purchase. They're not purchasing anything. We're the ones who are purchasing. Goodwill is okay to allocate, but not gain on bargain purchase. Okay? So realize that this amount here, realize that there can be positive for goodwill, but if it has to be negative, it cannot be related to a gain on bargain purchase. In other words, there is no gain on bargain purchase for NCI. What we have to do is actually do a reallocation of the book value to us. How do we do that? Well, we're going to back out now from what we saw up above here. So start by looking at this 10,000. Get rid of that. And say, kind of forecast ahead and look and say, oops, if we're going to come down to this 8,000, we cannot be dealing with any fair value adjustments. Let's just bring down the book value at 20% and say, look, we need to reallocate some of that book value over to the good folks who own the majority share, that being us. Okay, so that enables the book value. The rule is make book value equal fair value if you've got a situation where if fair value is less than book value, then make book value equal fair value, or reverse those two. That's just the tricky part. Make fair value equal book value. Okay, so that ultimately says, how do we do that? We need to reduce the book value down. We need to take that book value and reduce it down. And so that is what's going on here. I'm taking the book value that I've allocated, the 20%, and I'm saying, we're going to stop at 8,000. That's the fair value. Take the remainder, put it over to the 80% column. That being the case, the full amounts of the fair value adjustments will go to our column, because any type of gain on bargain purchase, that should just go to us. We're the ones purchasing. So when we do that, what happens? My total now is 41,000. One, 4, and the 6. So I got 41,000, or 41 million, however you want to call it. And then I'm taking an additional 2 million reallocated from the 20%. This is the reallocated book value. Okay, taking that from the 20, add that, and what I get is 43. Now from there, I can look to see, hey, let me compare that. This is going to be now my investment in the subsidiary is the 43, by the way. This is my investment, 43. Now let me compare that to what I paid, 40 million. And when I do, this is not, this 3,000 is a reduction, or 3 million is a reduction. That's my gain on bargain purchase. Ordinarily, that would be positive and be goodwill, but in this situation, I've got a weird looking negative number. How does this journal entry sort of play out overall? Well, essentially, when I do my investment in DMI, the subsidiary, I can input either cash or the fair value into that initial investment, but I can't put an amount less than the investment in the company. So 43 million is going to be my investment. I'm crediting cash for only 40 million, which means I need another credit, gain on bargain purchase, which affects my income statement, 3 million. No goodwill in this case. That's the journal entry. How does that look in my general ledger? Let's break this sucker down as we've done in the past here. So my investment in DMI is going to be put side by side in my notes, NCI's investment. And in their case, it's 20%. So we keep this straight this time. 80% we own. Okay. So filling that up, I could just put in the full 43. That's fine. But honestly, I think in this situation, we need to kind of break things down. So the initial book value up above was 40 million. And we did this 10 allocation, right? Then we went through and said, we're going to take the full land adjustment, 1,000. The full PA adjustment, 4,000, 4 million. And then urinary infection, 6 million. And there's no goodwill in this case. So if we just sum that up, we're going to get to 41,000. But we also had up above this $2,000 reallocation of book value. So over in NCI, I'm going to sort of show that $2,000 reallocation and just stick it over there. Reallocate book value. Okay. Now when I sum those up, guess what they equal? My investment, 43 million here. The fair value, which is always what we show as the NCI portion, fair value, 8 million over there. Now that those things are in there, what would be the consolidating journal entry immediately after this journal entry? Okay, so let's not allow 1 year to go by. Let's just go about doing our E and R journal entries. E journal entry says, let's take the book value and get rid of it. So there's the 40 million gone. And this is going to look weird. 10 million, get rid of that. Okay, that's my E journal entry. And these are on top journal entries. And when I do that on top journal entry, my on-top temporary balance. Now, what would we actually see in the GL? But at this point in time, if I took a temperature, I said, what would be my balance here? I would have 3 million still left as a balance. And here would be a weird looking, why do we have a credit in NCI? We're not done yet. R, it would be our next journal entry. In R, in our case, we're taking essentially, we're going to take all of those accounts, including the reallocation of the book value. We're going to stick that sucker down here. That net is 3. So get rid of those guys. Those are gone. What about this guy? This looks weird, right? How do you get rid of a credit? Well, guess what? You get rid of it with a debit. Huh? Exactly. Just follow along. Do what they tell you to do. In the end, trust, have faith. It's all going to work out. And when we do that, our on-top balance in the accounts will finally be 0. Okay? Again, bear in mind, on-top journal entries are not recorded in the system. They're just recorded for worksheet purposes. Okay, so I've got this, how we essentially input all those different amounts in the general ledger to recognize our investments, and then we go about E and R journal entry as we normally do, getting rid of the fair value adjustments. The only difference in this case is just realize that we've got this reallocation of the book value. It's best just to kind of keep that in line with the rest of the fair value adjustments when we go about doing our E and R journal entry. Now, for fun, let's go about kind of drawing out what the journal entries would look like in the case of E's, right? We're still going to debit away all the common stock, the APIC, the retained earnings at their full 100%. Okay, so whatever DMI is showing, get rid of that. And the amount that we showed up above was 50. That was the book value of the net assets. Here, I'm saying we have to split it between our investment and the non-controlling interest, which case was the 40 million and the 10 million. Then when we came through and did the R, we're doing our debits as we normally would. So in this case, there was those unreported intangible assets that are now going to be reported. So we report those at 100%. What was 100%? Well, it was this full 6 million. So 6, okay, is what I show there. I'm going to skip a line here because I know we have some weird credits. Credit the land, because land had to go down by the full 1 million. And we have to credit plant assets, reduce that down by 4 million. As you can see with our R journal entry, what we did was we credited the investment account because that was the remaining balance, was the 3 million. So what am I missing in this case? Well, if you add these guys up, 1, 5, 8, we need another $2,000 debit here. And guess what? That's, in this case, the debit goes to non-controlling interest. And that's the reason why we did a debit there, is we had to essentially just plug in that to make the journal entry balance. So my recommendation is when you go through and you sort of practice spilling all this stuff out, go through as you normally would, but pay attention to whether or not there's a gain on bargain purchase. Take a step back, go through the process we just did above, and make sure that the journal entries actually balance. The eliminating and consolidating journal entries all balance at the end. Okay, for my final exercise, for my last trick, what I want to do is go through a situation where we have a goodwill impairment. Okay, this is really where we have to pay attention to the allocation of goodwill, especially when we have our ownership percentage does not equate to the allocation of goodwill that we record on our books. So as an example, I'm just going to zoom in here a little bit. Whoa, back up. When we've got 100% book value at, say, 10,000, and we have unreported intangibles of 15, and the fair value is 25. If we own 70%, that means NCI is the other 30%. Okay? Go through and do your allocations. So 7,000 and 3,000. Now, I'm just going to go ahead and tell you right off the bat, because I know from the previous example, we have to be very careful about any gain on bargain purchase. There is none in this case. In fact, when we look, there will be goodwill in this example, and we will find that the amount, the fair value in this case for NCI is, let's say it's 17,500. That's the fair value. So let's not worry about a gain on bargain purchase in this case. While we're at it, might as well just give you a little heads up that the amount that we pay for our 70% is, say, 57,500. Okay, so let's go through and do our allocations of the various components of the company. 10,500, 4,500. Sum that up. 7,500. Sum that other one up. 17,500. Okay. Now, as you can see, in both situations, we've got goodwill. Okay, so 10,000 is a goodwill allocated to NCI, and in our case, the amount is, look at that, nice even 40 million. Okay, but when we sum those guys across, the total amount of goodwill is $50 million. What is 40 divided by 50? Well, it's 80%. 80% is not 70%. 20% is not 30%. So remember those problems before I said you might want to pay attention to this? Well, this is the reason why. Because down below, when we have to make any adjustments to goodwill, we need to do any adjustments in proportion to how we allocated goodwill. We're going to ignore any type of proportionate ownership. Okay, so down below, if we have investment in DMI, and right next to that for our notes we have NCI's investment in DMI, and we go through and we do our normal, hey, how much is book value? Book value in this case, 7,000 to me. For NCI, it was 3,000. What was the UI? It was 10,500 to me, and it was 4,500 to NCI. How was goodwill allocated? Goodwill was allocated 40,000 and 10,000. And while I'm at it, I'm just going to remind myself the 70% ownership, 30% ownership. This is 80% allocation, 20% allocation. Okay, now add those suckers up just to make sure I have the correct balances, and I have 57,500 here. That was how much I paid, and 17,500 is the fair value that they show and the market shows. Now let's assume it's going to go through and say during the year there was net income of, and I think I said 20 million. So we'll allocate that across to our ownerships. 14,000 to me. How much to NCI? 6,000. Okay. And we have to be appropriate and show the other columns here. So there's the equity in the subsidiaries, or DMI. We'll say it's DMI again. Equity. And then right next to it, NCI. NCI's portion of the equity. And so over here, I would say that when you have a credit of 6,000 to offset that, another 6,000 debit, and the 14,000 would have a $14,000 credit here. And let's also assume, while we're at it, that the unreported intangibles have a 5-year life. And so if I take up above, what was it, 15,000, and I divide that by 5, I get $3,000 amortization per year. So I'm going to get rid of my portion of the UI relative to my ownership. The overall life of the 15,000 is 3,000 per year. So there's a 3,000 per year amortization of the UI. And so my portion of that is 70%. So 2,100 debit 2100. NCI's portion of that amortization is 900, debit 900. Now, here's the new thing. I'm going to have a goodwill impairment. And the total amount of the impairment is $4 million. Now, most people miss this as a question on the exam. Don't let it be you, okay? I'm not going to do a 70-30 split, okay? I'm going to focus on that 80-20, okay? So, when it comes to any type of adjustment to goodwill, just make little notes. Please save yourself the frustration. 80% of the $4 million is going to be 3,200 here, and this is going to be the other 800 over here, and we'll debit and debit. That's how you do that. That's the main focus of this problem, is just be careful. If you have to make any adjustment to goodwill, don't do it based on ownership. Do it based on goodwill allocation. When I do that sucker, I come down to, I got 66,200. I've got 21,800. I got let's see here. I've got a credit balance of 8,700, I believe, and then 4,300 over here, if I'm not mistaken. Hopefully I'm not. So, check my math on that to make sure it works and it makes sense. If you have any questions, let me know. Those are the notes I wanted to focus on for the sake of this chapter. If you have any questions, please let me know. Cheers.